Man, so many things happened over the last week. I mean, both in terms of the stock market and non-stock market related news. So let's talk about the main points that happened last week. But first, something entertaining, right? Let's look at GameStop. Okay, so this is GameStop, and if we look at Friday, the week before, on March 5th, we can see that its stock price was $137.74. $137. That price is still so high for GameStop. But let's see what happened this week. On Monday, it went from $137 to $195. That's almost a 50% increase. Right? And then on Tuesday, it went from $195 to $246. That's a 25% increase. And then on Wednesday at midday Wednesday, it was $344. $344. So within 3 days, it went from $137 to $344. That's a 2.5 times return within 3 days. 3 days. And then within 30 minutes of Wednesday, like, holy cow, $344 all the way down to $198. I mean, if someone was buying it right here, $340, those bag holders, like, holy cow, like, they just bit the bullet and bought it at $340, and then boom, it dropped to $198. I mean, it went from positive 34% increase to a negative 20%, all within 30 minutes. The stock market had to halt GameStop, but after it halted, the stock went back up to $260, which is where it has been within the last few days. Currently, GameStop is valued at $18.44 billion, okay? That is 18 billion more than what it was valued a year ago. If we look at the chart right here, we can see that currently it is at $264. But a year ago, it was only worth $4.37. That means a year ago today, GameStop was only worth $370 million. $370 million. Now it's worth $18.44 billion. In 1 year. In 1 year. Holy cow. Okay, now let's get started. There were two big catalysts that affected the market last week. And the first one is the bond market. The second one is the $1.9 trillion stimulus package. We'll talk about each one in detail, but first, let's talk about the bond market. Now, if you're like me, you would be thinking, why in God's name should I be worried about the bond market, okay? I don't trade in bonds. I don't even have bonds. Like, why do I care about the bond market? Well, you might not care about the bond market, but the bond market cares about you. Because within the last few weeks, the bond market has had some crazy movements, and it is reaching a point where it is affecting the stock market, and especially your stocks. Okay, so this is the 10-year Treasury Yield, and as you guys can see, at the end of January, it was only 1%. And now it is a 1.6%. That is a 60% increase in bonds. And you guys need to know that it's a bond market, okay? It doesn't shift that much, right? It doesn't change that much. But because of everything that's been happening, it's been crazy. So now, why does this affect the stock market? Well, there are two main reasons. The first reason is inflation rates. When bond yields rises, inflation rates tend to go up. But when the February data came back and it showed that inflation rates was pretty much stable and what it was expected, things were a little bit different. And this paragraph perfectly summarizes what is happening. It says that the report underscored that underlying inflation trends in the economy were remaining muted even as economic activities and mobility began picking up. suggesting the Federal Reserve could in turn maintain its easy monetary policy posturing and avoid raising interest rates in the near term to stave off fast rising inflation. In general, low interest rates is good for the stock market, while high interest rates is bad for the stock market, since inflation rate hasn't gone up more than expected and the Federal Reserve is unlikely to change its low interest rate policy anytime soon. Alright, now let's talk about the biggest news of them all, which is the $1.9 trillion stimulus package. I'm obviously not going to cover the whole thing because you can watch another video for that. There's a lot of good videos. But the one thing that I do want to cover is when it was passed and how the market reacted to it. Okay? So let's do you guys a timeline. Okay? The Senate passed the $1.9 trillion stimulus package on Saturday. So they passed it on Saturday. It went back to the House on Wednesday, and the House signed it on Wednesday. And then President Joe Biden signed the package on Thursday. Okay? Now, how did the market react to that? So this is after the Senate passed the bill for the stimulus check. And once that happened, it is, I'd say 90% certain that they were going to pass a $1.9 trillion stimulus package. So on Monday, people knew that it was pretty much certain. And the S&P still had a negative day. Right? The NASDAQ, holy cow, look at this. Look at this drop. The NASDAQ had a horrible day. But the Dow had a great day. It went up like around 1 to 2%, 2 something percent. Now Tuesday with almost no news about the stimulus check. The NASDAQ shot up like crazy. So did the S&P. The Dow Jones stayed kind of flat. And the reason for this massive spike is because the Treasury yields dropped. The Treasury yields dropped on Tuesday. That was one of the big reasons why the indexes went up. Treasury yields dropping means that indexes go up. Treasury yields go up kinda means that the indexes go down. That's a general trend. Now Wednesday, the NASDAQ kind of had a negative day. The S&P 500 also had a negative day. The Dow Jones had another good day. Thursday was a big day for the NASDAQ because the House of Representatives signed the $1.9 trillion stimulus check, so the stimulus package. So they sent it off to President Joe Biden. He said that he was going to sign it. So NASDAQ had a good day. S&P had a good day. Dow Jones had a semi-good day. Then on Friday, right after President Joe Biden signed the stimulus package on Thursday, Friday, it was a negative day for both the S&P and the Dow Jones. Why? Right after the stimulus package was passed, negative day for the S&P and the NASDAQ. Dow Jones had a pretty good day. So overall, the Dow Jones has had a very, very good week. All right, so now let's look at the overall trends and see what is likely to happen next week. So if we zoom out to the 3-month chart, we can see that the indexes have been going down ever since around mid-February. It's going down, down, down. But right here, it kind of hit its all-time low. And now we can see that it is starting to move back up at a very rapid rate. Okay, if we look down here at the MACD, we can see that the MACD is just crossing the signal line, which means that it is probably going to go up. Probably, okay, unless some things happen, it is probably going to move back up to where it was before. Also, the relative strength index, it is still fairly good. It's currently at 59. At its highest point, it was at 65. So there's still some room to grow for the relative strength index. But from the chart, it is likely that next week is going to be a positive week. But that is only my opinion. Make sure you guys do your own research before you guys invest. Hey, I'm not a financial advisor. Okay, now before I end the video, I just want to show you guys a couple of the earnings that are happening next week so that you guys can be prepared to buy or maybe sell before the earnings. So first off, we have fuel cell. Fuel cell is going to be on Tuesday. It's going to happen before the market opens. So make sure you guys watch out for that. On Wednesday, the 17th, Jivo and Sundial is going to announce their earnings. Next is Thursday, the 18th, and we have Accenture. Right? They are going to be posting their earnings before the market opens on Thursday, the 18th. Then we have Carnival, which will also announce their earnings before the market opens on Thursday. Then after the market closes, we have FedEx announcing their earnings and Nike announcing their earnings. All right, guys, so that's all that I have for you guys today. Thank you so much for watching. I hope you guys enjoyed that. If you guys have some comments or have something that you guys want me to cover, please leave it in the comments below. And if you guys haven't done so, please hit the like button, please hit subscribe, and I'll see you guys next time. Bye.